Shell's share price has dropped by over 50% in the past 12 months. Does this represent a unique buying opportunity, or is this potentially a value trap? This is what we will be reviewing in today's Investment Store. Welcome to the Investment Store, the personal finance channel where we review a diverse range of investment asset classes, from stocks and ETFs to real estate and cryptocurrencies. If you enjoy this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. With that said, let's commence with today's video. Firstly, a brief background on the company. Royal Dutch Shell is a British-Dutch multinational oil and gas company headquartered in the Netherlands and incorporated in England. It is one of the oil and gas super majors, and in 2018 was the third largest company in the world and the largest based in Europe. Shell has operations in over 70 countries, produces around 3.7 million barrels of oil equivalent per day, and has 44,000 service stations worldwide. Shell is listed as two companies on the London Stock Exchange, Royal Dutch Shell A and Royal Dutch Shell B. This can be a little confusing, but it's important to note the difference between the two. In summary, Royal Dutch Shell A historically represents the Dutch division of the business and makes up approximately 60% of the company. Royal Dutch Shell B is the UK division of the business and represents the remaining 40%. Now, holders of Royal Dutch Shell A shares need to pay withholding tax on their dividends. So for the purpose of this video, we will be looking at Royal Dutch Shell B. Now, Shell is a vertically integrated business, which means that it is active in almost every area of the oil and gas industry, including exploration, development and extraction, manufacturing and production, which includes refining and power generation, transportation, distribution and trading, and sales and marketing. Ben van Beurden has been the CEO of Shell since 2014. Van Beurden is a Shell lifer who joined the firm straight from university and has held senior roles across the business. In April this year, Shell announced a 46% reduction in quarterly net income and cut its dividend for the first time since World War II in response to this. On July 30th, 2020, Shell published their second quarter results, where they implied that performance was likely to remain sluggish for the remainder of Q3 as the impact of lower oil prices begins to take its toll on the business. At the Investment Store, we take a four-step approach to analysing stocks. This comprises of, firstly, looking at the economic moat of the business, where we analyse whether a company has any form of sustainable competitive advantage. We then look at the fundamentals and assess the organisation's financial statements with key investment ratios. Next, we compare the stock with other companies and investment funds in the same sector to assess how it's performing within its market. And finally, we calculate the intrinsic value of the stock to see whether it's trading below its fair value. Once we've completed our four-step analysis, we will aggregate these scores to generate the Investment Store score, or ISS, for the stock. Now, with that said, let's start the analysis. At the Investment Store, we break down economic moat into 5 components. Intangible asset, this considers whether their brand gives them an advantage. Switching costs, are their customers tied in due to high switching costs? Cost leader, are they a profit or loss leader? Network effect, do they have an ecosystem in place that continues to generate multiple sources of revenue? And scalability, can the company scale at a lower cost than its competitors? Shell is one of the largest super majors, and it is well equipped to deal with lower oil prices than small to mid-sized oil companies. It also has a strong brand, so we've scored this a 3. In terms of switching costs, Shell's upstream portfolio rates feature some of the highest costs among its peer group. Yet despite this, it still manages to grow its market share, which implies that some of its clients are tied into their services. This is a sign of competitive advantage and economic moat. In terms of cost effect, it's estimated that Shell requires oil to be priced above $60 per barrel in order to guarantee sustainable returns. Today, Brent crude is at approximately $45 per barrel, so below this $60 target. Shell will also compete with state-owned oil and gas entities in certain geographies, and these companies can often undercut them, so it can leave them at a pricing disadvantage. With this in mind, we've scored cost leader a 2. For network advantage, as a vertically integrated supermajor, Shell can benefit from a boom in areas involving other segments of its extensive value chain. For example, a boom in plane manufacturing or car sales will boost their downstream income. With this in mind, we've scored network advantage a 3. Efficient scalability in the oil and gas sector is largely dependent on geographical location. For example, scalability is higher or more favorable in countries where Shell faces lower levels of competition. Shell has expansive operations in these countries, so we've scored this a 3. This gives an overall economic moat score of 56%, so fairly average. Before we move on, it's important to analyze the status of the oil and gas market. There are a number of economical, geopolitical, and social factors that affect the industry and the fortunes of businesses within it. The cost of renewable energy is declining rapidly and may soon challenge the viability of traditional carbon-based energy sources. Having said that, oil and gas still makes up over 50% of the global energy mix, and this is actually set to increase over the next 20 years, implying that oil prices could increase over that duration. Shell's performance is correlated with oil prices, as you can see from this chart. What's interesting here is that Shell's share price often lags the price action of crude oil by a few months. After crude's recent rally, the gap in price performance between crude and Shell is at its widest in 5 years. And this indicates that we could potentially see some recovery in Shell's share price over the coming weeks. Moving on to fundamental analysis. Let's take a look at Shell's financial figures and key ratios. At the investment store, we take a long-term view when analyzing a stock, and we adopt value investing principles which involve looking for sustainable growth in revenue and earnings, a good return on capital and assets, low levels of debt, and positive cash flow. So let's first consider Shell's revenue, net income, and net margin. Well, as we can see from the numbers on the table, these figures have been increasing steadily over a 5 to 10 year period. As we can expect from the global market conditions, this trend will be disrupted in 2020. This is reflected in Shell's latest interim results, which revealed that revenue had reduced by 64%. Shell also posted a staggering 18.1 billion loss during Q2 at the height of the global lockdowns. This is a significant amount. However, it should also be noted that it's mainly attributed to a 16.8 billion impairment write-down relative to lower oil and gas prices. And this means that the actual trading loss for the quarter is approximately 1.3 billion. Still a major loss, but not quite as alarming. As expected, Shell's margins have dropped significantly as a result of this. Let's look at return on asset and return on capital employed. What we see here is a similar tale. Steady growth over the past 5 years, indicating that Shell's guidance on obtaining operational efficiencies has not had a negative impact on growth. Once again, this trend will not be maintained in 2020, and later we'll look at how this compares with other companies in the sector. Moving on to debt to equity. From a debt perspective, Shell had maintained a fairly reasonable debt-to-equity ratio up to 2019. However, the Q2 results show that this is increasing slightly. At the investment store, we generally like this value to be less than 1, although it should be noted that this is not always possible in certain industries. If we were planning to purchase this stock, we would take a closer look at the root cause of this increase. Finally, let's take a look at Shell's free cash flow yield. We like using this calculation to get a good appreciation of an organization's cash flow management. Also, we find that organizations with high free cash flow yield often have a competitive advantage in their sector, and this typically means that their share price has a tendency to increase over time. Shell's free cash flow yield has been somewhat erratic over the past 10 years, but has seen plenty of strength in recent years despite lower oil prices. Shell's current free cash flow yield at Q2 2020 stands at -1%, which actually isn't that bad given the circumstances. So, to conclude our fundamental analysis, we've given Shell a score of 7 out of 10. Next, let's do a comparison of Shell against other super majors, and we'll also include a comparison with the SPDR Energy Select, which is one of the leading oil and gas ETFs. A word of caution with this comparison is that US companies follow different accounting rules, which can make comparisons inconclusive. Therefore, this isn't financial advice, and it's always worth taking the time to do some extra research when comparing companies in the US with other companies around the world. So first, we notice that Shell currently has the second lowest price to earnings ratio amongst its peers. This gap is quite unusual, as companies in the same sector typically fall within a narrower range than what's shown here. A lower PE is certainly an advantage, so we've scored this a 4 out of 5. For the current ratio, Shell's proportion of current assets to current liabilities is in the middle of the sector range, so we've scored this a 3 out of 5. We typically like this number to be above 1.5, and Shell falls below that, so that's something we would also take into consideration. Despite Shell's recent dividend cut, its dividend yield is near the mid to high range in the sector. As long-term investors, we always like good income generating stocks, so we've scored this a 3 out of 5. Earnings per share is at the lower end when compared to Shell's peers, so this scores a 2 out of 5. Return on capital employed in 2019 was again mid-range, so we scored this a 3. Shell's price to book ratio is currently the lowest when compared with its peers, and its ratio of 0.58 means that it's currently trading at almost half its book value. Again, this is a positive sign from a value investment perspective. It's also considerably lower than the SPDR ETF, which has a price to book ratio of 1.19. So we've scored this a 5 out of 5. Next, debt to equity ratio. Shell's debt to equity is in line with most of its competitors. As mentioned earlier, we would pay attention to the recent increase here, but for this analysis, we've scored it a 3 out of 5. And free cash flow yield, Shell has the second lowest free cash flow yield in the sector. So although the figure is not poor, we've scored it a 2 out of 5 as we're comparing it with competitors. And finally, Shell's share price is down 46% on its 2019 average, which is the second biggest drop on this list. Whilst this should not be taken as a measure of value, it does give some indication of potential upside for a stock. Therefore, we always find it useful to pay close attention to this, and we score Shell a 4 out of 5 in this area. The final step in our analysis is to determine the intrinsic value of the stock. At the investment store, we use a discounted cash flow method and Gordon growth model to estimate the value of an investment based on a company's future cash flows. Using an annual growth rate of 5%, which is fairly modest when compared to Shell's pre-2019 growth rate, we calculate an intrinsic share price of £26.57. Taking a conservative approach and assuming a 1% annual growth rate, this calculation reduces to £17.78. At the time of preparing this video, Shell's share price is approximately £11.30, which is significantly lower than this number. This means that there is potentially a high margin of safety in the share price, and with this in mind, we have given Shell an intrinsic value score of 9 out of 10. So to recap, Shell has recorded the following scores in each area of our analysis, and this gives them an investment score of 7 out of 10. Whilst there are certainly clear areas of value, it should be noted that Shell's fortunes are closely correlated to oil price. So in summary, an investment in this stock largely depends on how bullish you are on the price of oil. Should we witness an increase in global oil demand, it is likely that we will see an increase in the revenue and share price of most energy stocks, with Shell being no exception. Before investing in this stock, it will be worth paying close attention to their revenue, debt, and cash flow performance in future interim periods to monitor how they'll recover from the pandemic. It is also worth comparing performance with oil sector ETFs, which could potentially provide both a higher return and dividend. Thanks for watching. If you enjoyed this video, please hit the like button and let us know what you think of our findings in the comments below. If you'd like to learn more about how we analyze assets, please subscribe to the channel. We look forward to seeing you on the next video.